Hello, in this video we'll cover gross income problems and we're going to discuss problem 1. So in problem 1, Orange owned 100 shares of Citrus Corporation stock, which she purchased on January 1st of year 1 for $10 per share. Now on December 31st of year 3, she sold 50 shares for the fair market value of $30 per share. So we're going to look at what is Orange's economic income, financial income, and gross income, and specifically I want to focus on years 1 and years 3 in this problem. Now this problem deals with many things. We're talking about taxes, but to understand the definition of gross income specifically when it comes to taxes, we have to understand the difference between economic, financial, and tax gross income. Because the idea is that, as you saw in the previous videos, gross income is a legal definition, but it really starts with a baseline of economic income, but it does have some adjustments with respect to financial where it's a little bit more restricted. So if you recall, in the previous videos, we talked about economic income versus financial income. So on one end of the spectrum, we have economic income, and on the other end, we have financial. And the idea is, again, that gross income, which is what we use for tax purposes, is it starts with a baseline of economic income. However, it's adjusted through the law and for various ways, mainly from an administrative convenience standpoint, which we'll talk more about in this video. And again, it's mentioned in the other videos. It's adjusted, and it doesn't take the baseline of financial income, but there are some elements where it does take a financial income standpoint. So if we're looking at year 1, let's start by looking at year 1. So in year 1, Orange has 100 shares of Citrus Corporation stock, which Orange purchased for $10 per share. So when Orange purchases the stock and Orange owns that stock, there's no income. It's simply an outflow. So if you recall from the discussion videos, whenever we go through a tax issue, we always have to look at really 5 questions. What amount of income? What amount of deduction? So those 2 questions can be viewed as, do we have any inflows that provide tax consequences? Do we have any outflows that provide tax consequences? And deductions, you also have to look at credits and whatnot. The third thing is if we have income or deductions, whose income are they, or deductions are they? Fourth is, when are those income or deductions actually taken on the tax return? And fifth is, what is the character of those items? Now again, we're focusing on gross income, so we're specifically looking at the income questions. So what amount of income? What? When do we have income? And who? And who has income? Those are really the 3 questions we're focusing on with respect to these gross income problem questions. And in all these problem videos, you're going to see that I reference those questions. So on year 1, at the beginning of the year, Orange owns this stock. Orange owns the Citrus Corporation, 100 shares of Citrus Corp. This stock has value. This stock has value. Now, economically, let's say the stock goes up in value. If Orange purchases it for $10 per share, which let's assume that's the fair market value at that time, let's say at the end of the year, it goes up to $15. This is just to add to the facts. But at the end of year 1, goes up to $15 per share. So that's an increase in value of $5 per share from the $10 initially purchased. From an economic standpoint, that's $5 of income per share for 500 shares. So $5 times 100 shares, there's $500 of income. Because the idea is that you now own those shares and the value of the shares has gone up, so you have economic income for that amount, because economic income is a very broad definition. However, for financial purposes, there is no income because it's an unrealized gain and there's no realization event, meaning a sale or a transfer or some way that it's been exchanged or legally severed or gone, and there's been some economic transaction that's affected it. This is an unrealized gain, so it's not recognized, which is what we care about for recording, so $0. Now, for tax purposes, we take the financial approach here. So in year one, it's also $0 with respect to gross income for tax purposes. Now let's consider year three. Now again, we have our same continuum, economic versus financial income. Again, tax takes a more economic approach when it comes to income. That's the starting point. The Haig-Simons definition of income comes from an economic sense of the word, but again, it's adjusted for administrative convenience and other elements. So we saw in year one when the value went up, but there was no economic event, the financial income was $0, and that was the same for tax purposes because we did not have a realization event. And that's a key element to note, is that when you look at tax income, the what question, what amount of gross income, you have to go through the three Glenshaw-Glass, the Supreme Court case, Glenshaw-Glass. You have to go through the three elements: accession to wealth, or your net worth increases, realization, and dominion and control. So realization is the issue. In year one, we do not have tax realization because we don't have this event, just like for financial purposes, same idea. And the reason that's in place is because, think about it, every time the value of your stock goes up or goes down, you would have to record that. That'd be an administrative nightmare for both you and the IRS to have to go and look at that in detail. So that's why there's that link from tax purposes, right? Gross income for tax purposes, and financial income. But again, overall, it takes a more economic approach. So what about in year three? At the end of year three, 50 shares are sold. 50 shares are sold for $30 per share. So from an economic standpoint, we would have an increase in value, economic income, let's just say from year one to year three, okay, of the $15 per share to the $30 for all shares, even the ones that are sold. So we would simply just take into account, because we can't double count the income, the $30 per share, that's the fair market value, minus the 15 times the 100 shares, because some are sold and some are not, but you take into account that, and that gives us $1,500 of income economically. For financial purposes, again, we don't take into account the non-50 shares that aren't sold because of realization, and the same for gross income purposes. So we only care about the 50 shares sold, and we did not count in year one, so it's actually times what we purchased them at, the $10, the difference between the value of the 30 minus the 10. So we take, sorry, this is 50 shares, not $50. We take the difference in value between the 30 fair market value and the 10, the amount we purchased it at, right, the cost, also known as basis when it comes to tax, which you'll learn more about that later. We multiply that, and that gives us $1,000. $1,000. And you notice that you see the $1,000 amount here, and that's only from those shares. The other portion, the other amount for the other 50 shares would be recognized economically, because this equals 2,000. 2,000 minus 1,000 is 1,000. That's the difference between the other 50 shares and the other 50 shares times the $20 amount. And those are not yet recognized because there's no realization event. And that's the same for financial and gross income. Now, what is realization for financial and gross income differs, but that is the same income. The financial amount of 1,000 is also the same for gross income purposes, because our net worth has gone up, yes, for all the shares, but the realization event is only on the 50 shares that have been sold. Only the 50 shares that have been sold. So what does that do? For gross income purposes, it takes more of a financial definition. And the purpose of this video is to show you that, yes, gross income does usually start off with economic income, a very broad definition of income. Gross income, tax income is extremely broad, economic definition. However, for administrative concern, financial income takes over with respect to certain transactions or certain events, and this is a perfect example. When you have stock that goes up in value, we don't recognize it, record it for tax purposes because, again, the administrative nightmare. So we take a financial view, and that's the idea. So we've looked at the what question. The when and the who would obviously be orange. And then when, again, we looked at year 1 versus year 3, so it depends on the year. There's not really any other issues, but again, in year 1, there's no gross income because we follow the financial approach, not the economic. And then in year 3, there's $1,000 of gross income because we follow the same as the financial approach, but we don't follow the $1,500 in year 3 for economic purposes. So I hope you've enjoyed this video. This really just helps you understand economic versus financial versus tax gross income.